Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, welcome back. It is September 28th as we're recording this, so we are not quite finished with the third quarter, but we are really close. And so the numbers aren't going to be finalized, but again, we're going to be close. So welcome back to another episode of Ticker Talk. We've got myself, Louis, and...
Hey, I'm here, Tom Kessinger.
And we're here to wrap up Q3 with you and maybe talk a little bit about what we might see in Q4. So we'll get right into it.
So as we speak, Friday, the market closed, had a good inflation report. Inflation is moderating and or staying under the estimated level. We're just under 3% on the personal consumption expenditure, PCE indicator, which is the Fed's favorite inflation gauge. So we can't get down to that 2% target. That last mile is sticky, but we are sort of on pace that inflation has cooled dramatically from 3 years ago. So as we stand today, the S&P 500 plus 12.95%. These do not include dividends. NASDAQ plus 16.43%. We do have 2 days to go in the quarter. As I'd like to tell Louis, I'm probably jinxing us, but we can only go down about 6% in the next 2 days. They put circuit breakers on at certain percentage levels. It's between 3 and 4% today. So we're going to be up. We're going to go with,
we don't want to have to deal with that.
Okay. All right. Anyway, it has, we're starting to sound like Groundhog Day.
Yeah.
In that it has been a really good quarter. Earnings have confirmed the numbers and where we are right now. And so, we're here to just sort of break some things down.
Yeah. So from a market standpoint, we've seen the Mag 7 sort of lead the way. And just this week, for the first time this year, all 7 of those companies were positive.
Oh, year to date.
And so, that's something that's been driving the market for sure. But in the third quarter specifically, we have seen some broadening out from the small cap and from some value-driven companies. So that's been good from a breadth standpoint to see the market really start to broaden out a little bit.
Well, the Russell 2000, I just wrote down the Russell 2000, which is an index of small companies, plus 9%.
That's big.
Year to date. They're finally joining the party, as it were.
We've been waiting about 2.5 years for them to join the party.
Now, part of that is a direct result of interest rates. So typically small companies that have to borrow to fund operations are the most subject to high interest rates, whatever you consider high, but borrowing costs, let's say it that way. So as they have to borrow money and those interest rates go higher, that hits their bottom line. And so now we're going the other way. We're seeing rates start to come down very, very slowly, but they are moderating. And so that should logically help small cap companies.
And that's been to your point, in comparison to these large companies that can either make investments through their cash flow or through their cash piles. So they don't even have to go get financing a lot of times.
They're not going to a bank asking for a line of credit. They go to the market and issue more stock, or they go to the market and borrow at corporate rates, which are significantly below any kind of bank rate that's out there. So very different animals as it relates to that.
So even though we're sitting here at or near our all-time highs in many of the indexes that are broadly followed, we've started to see consumer sentiment fall off a little bit. The investor is nervous.
The consumer's nervous.
The consumer is nervous, as evidenced by the UMich survey. But also, I mean, there's some ground to stand on there. Not to freak people out. We're not here to be negative Nellies. But valuation wise, the market has gotten expensive in a relative sense, and that starts to get people asking the question of, is it overpriced and is it going down?
Right. And of course, that's anytime you're starting to hit market highs, and we've had several record highs this year.
Yeah.
On the S&P, I think during different times we've hit close to 40. Yeah. I believe it's 41 or 42 different record high closes. Mm-hmm. Now, keep in mind, for those of you out there, that doesn't mean the market went up this huge amount. I mean, if you close at 6,500 and tomorrow we close at 6,501, that's a new high.
New high. That's
even
right.
though it was 1 point.
Yeah.
So those numbers are a little deceiving, but it's the trend,
mm-hmm.
right? It's that you've seen a number of new record highs that have hit. Also, Louis,
mm-hmm.
this year is what I call an all play.
Yeah.
So if you look across indexes, and for the first time in 10 years, international is actually outperforming U.S. markets. And a lot of that had to do with coming off of that sort of the Liberation Day. A lot of this country has been spending a lot of money. We've talked about things like that in the past. And so the dollar is weaker because the perception is that we're having to borrow more money to spend money, which makes our dollar weaker on a global scale. If any of you have been to Europe or Asia overseas and you do any kind of conversion, you're seeing a big differential in how many dollars to euros you're getting right now. But that is strengthening international investments.
Yeah.
They get a tailwind, your international indexes, as the U.S. dollar falls. Interestingly enough, you know what else gets a tailwind?
What's that?
And that's the reason our indexes are up as well, is foreign earnings. So guess what? Apple makes a whole lot of money outside the United States. Google, Facebook.
Yeah.
Facebook has 3 billion eyeballs that look at some type of their ad and or click through purchase.
Yeah.
So all of those things, it's an interesting year in that it is an all play in that regard. And we can talk about valuation. You have anything to add on that, international, or anything you're seeing?
No, I mean, just from the rate standpoint, that's why it is a really interesting time in the market, because you're starting to see, man, these valuations are getting high. And all you're talking about, with the dollar getting devalued a little bit, international taken off with the fear of, hey, the United States has to borrow at a higher rate. And all of that, sort of makes you nervous a little bit, but then you see rates start to come down and it's like, okay, I feel a little bit better. Maybe we can, restructure some of this debt and the dollar can strengthen a little bit. So that's sort of the other side of the coin a little bit on that front.
Right. So, let's talk a minute about valuation. So here we are, we're at record high numbers in terms of the S&P's at 6,643. We've talked about earnings confirming that, but if the market's always looking forward, right? So the estimated earnings, if you looked at the S&P 500 as one company, we've talked about this, so this is not a new concept for the people that are listening, is if it was one company, next year they're estimating that all those 500 companies will earn about $300 in aggregate per unit.
Yeah.
And so if I take 6,600 divided by the 300, it's 22. So that's a PE, a price to earnings of 22. That is high on a historical standpoint.
Yeah.
I can give you lots of reasons why that might be an exception. We're in a software. We don't need as much labor. I can do all those things, but historically, that is a high number. Anything over 20 is high.
Yeah.
and anything below 13 is really low. And the 10-year historical average is around 17, going back the last 10 years.
Yeah.
So it's a good time to take stock. It's a good time to take your statement out, look at it, smile a big smile.
Yeah.
And then go, okay, how much cash makes me feel comfortable?
Mm-hmm.
If a year ago that number was 5% of my portfolio,
Mm-hmm.
and it is 5% of what your portfolio was,
Yeah.
then maybe you need to add a little cash, sell some things while we're at market highs, better to sell into strength, and create 5% of what your portfolio is.
Yeah.
Does that make sense?
And so to put it differently, if you were to be sitting here and the start of 2023 and you just get into the investing game and you're in a 60-40 portfolio, you own 60% stocks and 40% fixed income, and that's where you felt comfortable.
That was your allocation.
At the starting point. Odds are, with no big rebalancing, you're sitting here now at a 70-30, 80-20
right.
Portfolio, not because fixed income's lost money.
Right. Yeah, your fixed income is actually higher.
Yeah, but your equities have grown at such a higher rate,
right?
That your original allocation is quite different,
right,
from what it is now. And so what you're saying is, take a look at that. Are you comfortable with that now?
Right.
Maybe you are.
Well, and you know what? Here's the deal. Take your portfolio, take your statement out today, and then I want you to go back and pull out your March statement.
Yeah.
While we were in the middle of sort of the tariff tantrum type of deal, and just make sure, like, how did you feel back then? Were you good?
Yeah.
If you're good, then maybe you're okay. If you're saying to yourself, man, I really don't want to feel that again, especially from this new higher level.
Yeah.
Right? Because as numbers go up, the fall feels more intense. I've always said you make money in percentages. Hey, S&P's up 13% this year. You lose money in dollars.
Yeah.
Hey, you guys lost me $200,000. Well, okay, you're right, but you have $10 million.
Right.
There's only 2% loss. I don't care. Do you know how long it took me to earn $200,000?
Well, there's the what's the saying that goes, maybe you start an IRA out, you put $1,000 in, the market falls 10%, you lose $100.
Right.
And then, hopefully the next time the market falls, you got $10,000 and you lose $1,000.
Right.
And from there, now your portfolio's at $100,000, and when you get a 10% pullback, you lose $10,000. So the goal really is, in a sort of weird backwards way,
to lose more money?
To lose more money in every market pullback. Because that means in between you made a bunch.
That's twisted.
It is. It is.
But it is time. It is time to do that. It is also time. I say this to people that I talk to, meetings that we have. Do you need anything?
Right.
Do you need anything? Do you need a car? Does your roof need to be replaced? Do you need shutters, gutters, paint? Like, if you need anything, please let's plan for that.
Take some chips off. Use your earnings.
Look at it. And again, we're not saying sell.
Yeah.
We're saying evaluate. That's a very key difference, because the other old saying that I've heard is this year's high is next year's low.
Yeah.
So we don't know when the market is going to sell off. What we do know is over time, companies follow earnings, and the earnings outlook looks pretty strong right now, as evidenced by the last quarter's earnings. Good news, we're heading into October. That means earnings season. We're going to get another round of either validation, or we're going to get
a reevaluation.
So we're asking you all, listeners, wherever you do your investing, to reevaluate your own situation. So maybe let's look at some things that have happened during this quarter. I mean, 90 days passes quickly and slowly all at the same time. And there are things that have happened that you're like, oh yeah, that did happen over the summer. So thoughts on that, Louis?
Yeah, I mean, so again, we had strong Q3 earnings, so that was really, really good. That sort of goes towards a talking point on that we'll come back to a little bit on a comparison of this market and the AI rally versus the .com boom and bust. So we'll come back to that. But, we saw strong earnings, so that's all taken place in the last 90 days. And, we saw rates get cut by 25 basis points. We also saw some different tariff announcements as we've seen since March, April. But those always tend to move the market when those come out. So we've seen really a lot happen in the last 90 days because, as you said, the days a lot of times can be slow, but the weeks are fast, and here we are, and it's been a whole quarter.
And probably the biggest thing, and we should talk about this, that just happened within the last 10 days. The Fed, whether you think they were bullied into it, whether the data leads you to believe it, it doesn't matter.
Yeah.
What matters is the action that they took, and they cut by 0.25%. So for those of you out there who have enjoyed, and it has been a pleasure to enjoy this sort of risk-free 4%, 4.25% rate of return on 30 to 90-day Treasury bills and Treasury money markets, that is starting to unwind itself.
Yeah.
So those rates are gonna start to compress. Those 30, 60-day T-bills are gonna start to compress down to 4%. That's the target.
Yeah.
Remember that we said inflation is around 2.9.
Yep.
So you're earning 4, depending upon your tax bracket. That is taxable income.
Yep.
You're gonna have to pay close to a percentage of that in taxes. So your real rate is 3%, and now inflation is 3%. So if eggs go up in price by 3%, your money's earning 3%.
Yeah,
everything's good.
You're at a break even.
The next rate cut, which we think is coming in October, and then another one in December, and then another one next year.
Yeah,
that math starts to work against you. So you need to start thinking today. What you're going to do, how you're going to do that. Some of that ought to stay in cash no matter what, because it's not there to provide for your lifestyle. Right. But some of you have been able to enjoy a pretty good lifestyle. When they were paying 5.5% 2 years ago, it was pretty good.
Well, one of the things that they talk about in fixed income investing are different strategies, and one that's being employed now a little bit more is the barbell strategy. So a lot of times you'll see sort of laddering, so kind of staggering things,
maturities.
So that maturities are coming due, once a month or every year, so that you've got a consistent way of reinvesting at newer rates. But one that has been a little bit more popular in terms of just being talked about, hey, what's this barbell strategy, is looking out, maybe saying, hey, I'm going to lock in some of these 4% 10-year rates because I don't know what's going to happen over the next 10 years. Right. So I'm going to lock this in right now because at least for the foreseeable future, I think rates are going to be lower than what they are now. So I'm going to lock in some now, but I'm also going to lock some in the very short term so that I've got some cash flow coming in. And I'm going to leave this middle term open. And not have these maturities coming in to let me sort of see what happens with the rate environment.
And then as rates get cut, you can start to think through, and you can look at past market cycles, different defensive type of names start to come to the forefront because they're paying 4 or 5% dividends that grow. Whether they're in the utility sector, the pharmaceutical, medical type sector, even oils. The price of oil has settled in here at a decent price where oil companies can make a profit on what they're pulling out of the ground. And so people start to look for other investments because cash just won't get it done. And that is part of why the Fed cuts rates, by the way. The Fed cuts rates to stimulate investment in other things. And not just in our world, home building, in buying rental properties and starting businesses. And we talked about the small caps making borrowing costs. That's what the Fed's doing. They're trying to stimulate the economy through less restrictive borrowing costs.
And one of the other things that we've talked about is the role that the Fed plays with unemployment, and they absolutely are looking at the unemployment market. And one thing that can sort of get misconstrued in different ways of wording things. So you see job growth slowed.
Yeah.
And that's kind of a scary headline. And
that's intentional.
It is what they call a leading indicator. So as job growth slows, then the thought is eventually the economy is going to slow,
right? Because
fewer people are being hired. But I do want to be clear. The first two words of that are job growth. There is still job growth. We are still, at this moment in time, hiring more than we're firing. We're at almost a record unemployment rate,
and
right around 4%. And so, there are positives.
And a really important piece of this, and this is what carried us in the mid-'90s through basically 2006, productivity. So these tools, these AI tools, these ability for one person to do more, to get more done at their work, at their employment, is starting to take hold here in the economy. And so productivity is one of the things that really juices the GDP and the economy. And you got fewer workers getting more things done. So that's why you're maybe also seeing some slowing there. Not to mention, we're at 96% employment.
Right.
There is some
4%
number.
Unemployment means 96% employment.
There is some number where it's just like that is considered, quote, full employment. So everybody who wanted a job, actually wanted a job, has one.
So on the note of productivity, let me play news anchor here for a second.
Thank you.
And just because there are all these talking points, and you're going to see these things in articles and on the television. So one of the main ones over the last year and a half has been, all right, we've got this AI boom. All of these companies are investing in AI, and are they getting the return that they're promising? And now I'm really going to scare you and compare the AI boom to the .com boom of the late 90s and early 2000s that eventually became a bust. And they sort of leave it there, and the last word you hear is bust, and then you sort of insinuate, oh my gosh, this AI thing, I don't know, is it going to pan out? So there are a few things that are very important to remember when it comes to the AI sort of realm. One being productivity. It has real-world applications already. At the time of the .com boom and bust, it was all theoretical.
There was a lot of theory back then. I was around back then.
Yeah, you can speak much better to it.
Yeah, there was a lot of hope that there would be people on the internet, that they were pushing out fiber optic wire across the country in the hopes that people would buy into this internet and all things web. And it did happen.
Yeah.
It took a long time, way longer than they thought, for it to happen. I was telling Louis, one of my recollections is one huge difference is the amount of cash that these companies are creating now, even while they are investing in these different AI functionalities, data centers, etc. But, I go back to 1999, the year 2000, there's the pets.com ad, the sock puppet that's on there is talking about order your dog food on, order me dog food, and little sock puppets saying all that stuff. Nobody ordered any dog food online because they didn't have they weren't thinking that way. Was it wrong? Should the sock puppet be in the Smithsonian? Probably. But it wasn't wrong.
Yeah.
It was just early.
Yeah.
Right? Today we got Chewy's.
Mm-hmm.
Chewy's is a multi-billion-dollar company who delivers to my house twice a month, 1 box for the little dogs, 1 box for the big dogs. So it was the right idea. It was the wrong time.
And it's sort of funny to look and see, like, what did it take for Chewy to become so successful? Well, first, it took 10 to 15 years of everybody actually being on the internet and having a smartphone and starting to live their life in some sort of web-based way. But it also took partly a global pandemic.
Yeah,
and then you create the habit of, well, I'm not going to the store, I'm going to order this, they're going to deliver it, and then the world opens back up and it's like, well, this is
a lot
awesome.
easier.
I don't have to carry a 50-pound bag, through the store and then to my car and then inside. I just got to open a box that gets delivered.
Right. So that's, when you look at the comparisons and you hear that comparison, do take it with a little bit of a grain of curiosity is what I would tell you. Mm-hmm. What does that mean? The .com bubble, I mentioned, 15 minutes ago about the price to earnings ratio of the index at 22. Forward projection looks a little elevated. In 1999, that was 41 times, double where we are today. Why? Because in 1999, there was no E.
No earnings.
There were no earnings. Pets.com went public. And they took all that cash and they sunk it into a Super Bowl ad, praying that people would click onto their site and order stuff. They didn't. And they ran out of money.
Right.
NVIDIA is not running out of money anytime soon. As a matter of fact, they're investing in things that are integral to the solutions of this new technology that is hopefully going to be productive from a productivity standpoint for workers, but lucrative from an earnings standpoint.
And you're seeing the adoption already. I mean, in some ways, right? The verb Google is getting replaced by, hey, I'm gonna chat GPT this.
Yeah.
Because you get a faster answer. Is it more accurate? I don't know, but it's easier to find.
And Google will not be left standing. They are coming out. They got their Gemini. Hey, they're not going to just let them take their market. So they're gonna come in. Meta, Facebook they're like, hey, wait, we got something to do here. Like so competition's a good thing.
It's good.
We'll see. It is driving them. But they are funding this with cash. They're not going public and taking those dollars and doing stupid things. They're not borrowing to do these type of things. It's cash flow from operations, which hits their earnings. And so then you as an investor have to decide, is that a good investment?
Yeah.
Well, that's what makes markets.
And we saw it just as an example before we wrap up. I mean, we saw it in Meta being early or wrong, pick your wording, on the metaverse.
Right.
They invested billions.
Right. Got punished.
Then doubled down, invested more, saw no return, and the market said, hey, you need to stop doing this. And they did.
They pivoted.
They've pivoted to this AI. And so, we'll see.
Yeah, we'll see. But their stock has been rewarded for pivoting.
Big time.
So, well, I just think, heading into the fourth quarter, summing this up, get your statement out, look at your allocation. Is it where you want it to be?
Yeah.
Do you have something you need to spend? Do you have a charitable gift that you've pledged that might be good to make a gift at this time with markets at a high? And just get yourself set up, because One of the things we started the last podcast with was, hey, what's the best performing month,
Yeah.
over the last 100 years? It was July.
Yeah.
Well, it was.
Mm-hmm.
What was the worst performing?
September.
Turns out wrong.
Not
September's,
Not too bad.
I love being wrong when it goes our way. Month to date, September, S&P's up 2.8%. So,
Yeah.
but that means take advantage of that strength.
Absolutely. Take advantage of it going into the fourth quarter. We will see you back in early January, and we'll get to find out if we got a Santa Claus rally going into the end of the year or not.
All right.
See you next time.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell or solicitation of an offer to buy or sell any security or investment or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird & Company Incorporated. Please note past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird & Company Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.